Welcome back to the Daily Crypto Roundup. Today's crypto market has been hit by one of the sharpest fear waves we've seen in a long time, and the headline number is simple. Bitcoin has broken below $60,000, touched the $58,000 region, and dragged the wider market with it. But here's the important part. This is not just another normal red day. This is a market being hit from multiple directions at once. We've got inflation fears coming back. We've got traders being liquidated. We've got options expiry pressure. We've got strategy shares under serious stress. And at the same time, we've got some analysts saying Bitcoin may actually be getting close to a major inflection point. So today's roundup is about one question. Is this the start of a much deeper crash? Or is the market setting up one of those brutal bear trap reversals where everyone gets too negative right before Bitcoin snaps back? Before we get into it, remember this show is sponsored by Kraken. If you are trading crypto and you want to support crypto news today, signing up through our Kraken partner link is one of the best ways to do it. We are also giving away 20 XRP to listeners who sign up and get involved. It helps keep the show going, but as always, nothing in this episode is financial advice. Do your own research, manage your risk, and never invest money you cannot afford to lose. Now let's start with the market board. Bitcoin dropped below $60,000 and hit an intraday low around $58,188 before recovering slightly back toward the $59,000 area. Ethereum was trading around $1,560 after dropping nearly 5%. XRP was around $1.03 after falling close to 4%. Solana was near $66. BNB was around $553. The wider crypto market cap fell to roughly $2.13 trillion. And the damage in derivatives was even bigger. According to the liquidation data, more than 217,000 traders were wiped out over the past 24 hours, with total liquidations reaching about $1.48 billion. Long traders took the worst of it, with roughly $1.21 billion in long positions liquidated. Bitcoin alone accounted for around $665 million of the total, followed by Ethereum at around $359 million and XRP at about $50 million. That tells you this was not just a price move. This was forced selling. This was leverage being flushed out of the system. And when leverage gets flushed out, the moves can become exaggerated very quickly. Traders who thought Bitcoin would hold $60,000 were forced out. Stop losses were triggered. Liquidations cascaded. And once Bitcoin broke that psychological level, panic spread across the rest of the market. The macro reason behind this is inflation. Fresh United States PCE inflation data has reinforced fears that interest rates could stay higher for longer. The Personal Consumption Expenditures Price Index rose 4.1% year over year in May, up from 3.8% in April. Core PCE also remained high, and even though some readings came in slightly below expectations, inflation is still running well above the Federal Reserve's 2% target. That matters for crypto because Bitcoin and altcoins still trade like risk assets when macro pressure rises. If investors believe rates are going higher or staying high for longer, they become less willing to take risk. That hits technology stocks, speculative growth assets, and crypto. And that is exactly what we are seeing. The market is also dealing with one of the biggest Bitcoin options expiries of the year. Around $9.33 billion in Bitcoin options are due to expire, with a huge amount of call open interest sitting between $75,000 and $90,000. The max pain level is around $72,000, which is well above where Bitcoin is currently trading. That creates a messy setup. Options traders may be forced to adjust hedges, and that can increase short-term volatility. In plain English, it means the market could stay very jumpy over the next few days. But here's where it gets interesting. Even though the price action looks horrible, CoinDesk reported that derivatives and order book data are now showing signs of an overcrowded short trade. In other words, too many traders may now be betting on more downside. Bitcoin dropped fast, but open interest has risen while price has fallen. Funding rates are negative. That suggests traders are not just exiting positions. Many are actively piling into shorts. expecting Bitcoin to break lower again. That can be dangerous. When too many people are on the same side of the trade, the market can move against them violently. If Bitcoin starts pushing back above key levels, short sellers may be forced to close positions. That means they have to buy Bitcoin back, which can drive the price even higher. That is the classic short squeeze setup. CoinDesk also pointed to order book data showing stronger bid support below the market than sell orders above it. That does not guarantee a bounce, but it does mean the market may not be as one-sided as the fear makes it look. So we now have two competing forces. On one side, the trend is clearly weak. Bitcoin has broken $60,000. Liquidations are huge. Inflation is still a problem. ETF outflows are adding pressure. And prediction markets are now assigning a rising probability that Bitcoin could fall below $50,000. But on the other side, the market may already be getting overcrowded to the downside. Shorts are building. Longs have already been flushed. And when fear becomes too extreme, Bitcoin often becomes most dangerous for late sellers. That brings us to the next big story, the on-chain signal. Hyperion Decimus portfolio manager Chris Sullivan told CoinDesk that Bitcoin may be close to a major inflection point. According to the report, 4 rare on-chain indicators tracked by the firm have aligned for only the 6th time in Bitcoin's history. Previous alignments have coincided with major cycle bottoms. Now, that does not mean Bitcoin has definitely bottomed today. Sullivan was clear that Bitcoin still needs final technical confirmation. He laid out 2 possible paths. Path 1. Bitcoin breaks above the key $82,000 pivot, which would confirm a stronger trend reversal. Path 2. Bitcoin makes one final low, possibly in the $54,000 to $57,000 area, with a potential wick as low as $48,000 before the bottom is complete. That is a very important point for listeners. The bullish argument is not necessarily that the pain is over today. The bullish argument is that Bitcoin may be entering the final phase of the bear move, where panic becomes extreme, weak hands are flushed, and long-term buyers start building positions again. That fits with what analyst Don CryptoTrade said as well. He said he sees the current support zone as an area to gradually accumulate Bitcoin for the long term, rather than trying to perfectly call the bottom. That is probably the cleanest way to think about this market. Trying to nail the exact low is almost impossible. But if you have a long-term view, these are the zones where serious investors start paying attention. Another analyst, Leonard Snyder, said he had already taken profits on most of his Bitcoin short position after the latest breakdown. That is also worth noting. When professional traders start taking profit on shorts, it does not automatically mean the bottom is in, but it can mean the easy downside move has already happened. Now let's move to strategy and Michael Saylor, because this is a major part of today's fear. Strategy shares fell sharply, with MSTR trading around $86, its lowest level since February 2024. The preferred stock STRC also dropped to around $75, which is a 25% discount to its intended $100 par value. The key issue here is not immediate insolvency. CoinDesk reported that Strategy still has around 10 months of dollar reserves available to cover STRC dividend obligations. So this is not a simple, the company cannot pay story. The bigger issue is trust. Alexander Bloom, CEO of 2Prime, said repeated changes in Strategy's plans and the weak performance of MSTR and STRC have damaged confidence among retail investors. And that is important because Strategy's entire Bitcoin treasury model depends on investor belief. It needs the market to believe in the premium. It needs the market to believe in the structure. And it needs investors to keep trusting that the engine works. When MSTR trades at a huge premium to its Bitcoin holdings, the company can issue equity or preferred products, raise capital, and buy more Bitcoin. But when that premium compresses, the machine becomes less powerful. That does not mean Strategy is dead. It does not mean Saylor has failed overnight. But it does mean the market is now stress testing the Bitcoin treasury model in a much harsher environment. And that matters for Bitcoin because strategy has been one of the biggest symbols of institutional Bitcoin conviction. When strategy weakens, sentiment around the whole Bitcoin treasury trade weakens with it. Now, one slightly different story today comes from BlackBerry. Yes, BlackBerry, the old phone company. But this is not about phones making a comeback. BlackBerry is now being framed as a mission-critical software company for physical AI, robotics, smart cars, and autonomous machines. Its QNX operating system is used in environments where safety, security, reliability, and real-time performance matter. The company's stock surged nearly 23% after a strong earnings beat and upgraded guidance, with investors suddenly treating BlackBerry as a serious AI infrastructure play. Why does that matter for a crypto roundup? Because it shows where capital is still willing to move when the story is strong enough. Crypto is being punished right now by macro fear and leverage stress. But AI infrastructure names are still attracting interest when investors believe the product has real-world utility. That is a lesson for crypto as well. In the next phase of the market, hype alone may not be enough. Projects with real infrastructure value, real cash flows, real adoption, and real security use cases will probably be treated very differently from pure speculation. So what is the verdict today? The market is damaged, but not finished. Bitcoin breaking below $60,000 is serious. The $1.48 billion liquidation wave shows how much leverage has been flushed out. Inflation fears are real. ETF outflows are real. Strategy weakness is real. And if Bitcoin loses the $58,000 area again, the next zones people will talk about are $55,000, then $52,000, and possibly the high $40,000. But this is also exactly the kind of market where bottoms start forming. Sentiment is awful. Traders are crowding into shorts. Longs have already been punished. On-chain signals are flashing rare bottom-style patterns. And some analysts are moving from panic mode into accumulation mode. So for listeners, the clean takeaway is this: do not panic buy, do not panic sell, and do not get trapped using leverage in a market this volatile. Bitcoin is now in a major decision zone. Below $58,000, fear probably accelerates. Back above $60,000 to $62,000, the short squeeze setup becomes much more interesting. And if Bitcoin can eventually reclaim higher levels, the conversation changes fast. For now, this is a market for patience, cash management, and clear thinking. The fear is loud today. But in crypto, the loudest fear often appears close to the moments that matter most. Drop your thoughts in the comments. Are you buying this dip, waiting for lower prices, or staying completely out until Bitcoin proves itself again? Smash like, follow, and we will see you at the top.